Hey, what's up everybody? It's David here. Welcome to the TDB channel, where I challenge you to think, dream, and believe in yourself with a focus on personal finance. So it doesn't take long if you search passive income on YouTube or on any other search engine to find that the holy grail is real estate. And I totally agree. Real estate can be awesome. It can generate you great passive income cash flow every single month. But there are some challenges that come along with it. One of them is the barrier to entry. You have to have a large pile of money in the bank, or you have to leverage the property, meaning you're going to take debt and get a mortgage. And when you do that, it provides a level of stress and headaches and worries to your life that you may not want to have. And also, when you own real estate, it makes you a landlord. Now, being a landlord can be a good thing, but at the same time, even if you make sure you have the very best tenants that you possibly can in your properties, you've screened them, you've got background checks, you know they're solid people, they still get to call you anytime something goes wrong. So if you have a leaky faucet, a broken dishwasher, the roof starts to leak, the bathroom's messed up, they call you. Or they might call a property manager if you choose to go that route. But if you go that route, you lose some of the profit because you're having to pay the property manager a fee. So there's just some headaches that come along with being a landlord. And when you own that real estate, you have that large barrier of entry. But luckily, there's something called a REIT, which is a real estate investment trust. And you can get involved in these for as little as $100. But do you know something that's free and can gain knowledge and everything you want to know about personal finance? It's joining this channel. So go ahead, hit that subscribe button. Make sure you hit the notification bell so you don't miss an upload from me. And please, hit the like button on this video. But now seriously, let's dive into what exactly a REIT is. So a REIT really is just a company that owns and operates real estate properties that generate a monthly income. And those properties, when they generate the monthly income, it comes back into the company and ultimately comes to the shareholders as a dividend. And we'll dive into that here in just a little bit. And when these companies buy properties, they usually focus in on one specific sector of the real estate market. And so they really are just landlords in the traditional sense of the word, in that they're managing the properties and they're taking the monthly income that comes from the tenants. But while they could focus on residential real estate or commercial real estate and be some of the traditional types of investments that you might think of for real estate, they also have specialty sectors of these. So these sectors could be focused on lodging and resorts, and so a REIT like that would actually be purchasing hotels and resorts. You could also have some that are focused on storage units, or you could have some that are focused on infrastructure. So they could be looking at pipelines or cell towers. All the properties that a REIT owns makes up a portfolio. And now, as we talked about, these portfolios are generally focused on one specific sector. Now, these companies, though, they want to make sure that they're diversified just like we do in our personal investments. So they will go outside of their specialized sector and buy a few other properties that make up a smaller percentage of their overall portfolio, but this does allow them to become diversified. So let's say, for example, one of these REITs is focused specifically on commercial properties for doctor's offices. That might be 75% of their portfolio. But they're going to go out and they might buy 5% storage units, they might buy another 5% of residential properties, and then they might find 5 other percent in a different sector, thus making them a little diversified and not being as impacted if something were to happen to those doctor office commercial opportunities that they were looking at. So how did REITs come about? REITs came about when Congress and Eisenhower back in 1960 signed an amendment to the cigar excise tax extension. And what this provision allowed was for individual investors to invest in companies that held commercial properties that generated an income. And these investors would be paid through what's called dividends. So what qualifies a company as a REIT? Well, at a high level, they have to primarily own properties that generate an income, and they have to hold these properties for a long period of time, and they have to give the majority of the money that's made off the properties to the shareholders. But now if we look down at the actual details of what makes this company a REIT, well, let's look at those. They have to invest at least 75% of its total assets in real estate, cash, or U.S. Treasuries. They have to receive at least 75% of its gross income from these investments. They have to return a minimum of 90% of its taxable income to shareholders each year. They have to have a minimum of 100 shareholders after its first year of existence. And they have to have no more than 50% of its shares held by 5 or fewer individuals during the last half of the taxable year. So there's 3 main types of REITs. The first is an equity REIT, and this is really the type that you're likely thinking of right now. And these are ones where they own, operate, and manage properties that generate an income. And so their primary source of income in this case is through the rents they collect and not really through reselling of the properties within the portfolio. The second type of REIT is a mortgage REIT. They're also sometimes called MREITs, and in this case, they actually make their money through mortgages. And so what they do here is they buy and sell different mortgages, and they actually can do this either through direct lending, so this could be through a mortgage that you traditionally would think of, or it could actually be indirectly through acquiring a bundle of mortgages. So this is where the government or other private companies will bundle different mortgages together and then sell them off at a lower price. These companies will come in and buy these, and then they can make the difference. And the way they make the money on this is actually through the net margin of the interest rates. And so the difference here is what it costs them to actually fund that loan versus the interest rate that they're making and the profit they're making off of that. The difference there is their net income. The third type of REIT is just a hybrid REIT, which is a combination of the first two, the equity and the mortgage REIT. One additional note here is just how the REIT actually works. So there's really 3 ways that you can purchase a REIT. And so the first and most common way is through a publicly traded REIT. And so this would be like any other stock that you would buy on the open market. It's registered with the SEC and is publicly traded. Now, the second type here would be public REITs that aren't actively traded. So they're regulated by the SEC, but you can't purchase them on the open market, which makes them a little less liquid. And then the last type is a completely private REIT. And so these aren't regulated by the SEC, you can't trade them on the open market, and they're only available to a select group of investors. So now we need to talk through what exactly the pros and the cons of REITs are. Well, let's start with the pros. So the first is they're easy to buy and sell, meaning that you can invest in real estate, but you can still have the liquidity that isn't really available for you when you actually own the property yourself. Overall, you're going to get an absolutely great rate of return considering that you're eliminating the traditional risk of real estate. You don't have to worry about being a landlord and things going wrong, but you're still going to get the great cash flow that comes in the form of dividends. And so actually, according to the National Association of Real Estate Investment Trust, from 1972 all the way through 2018, the FTSE Nareit US Real Estate Index has produced an average total annual return of 11.4%. And if you look at the performance in 2019, the REIT sector actually generated 28.7% return, which is great. Now, it did fall just slightly short of what the S&P 500 index did at 32% in 2019, but still an absolute great rate of return. And now if we talk through the cons, well, with these great rates of return also comes some crazy fluctuation that happens in the stock market, especially if you look back at the 2007-2008 period of time. In 2007, REITs as a sector returned a negative 20.35%, and it did even worse in 2008, returning a negative 40.03%. Additionally, REITs don't really offer you much in terms of capital appreciation, and this is because of how they are required to be structured. So they must pay you 90% of the income back to your investors, which means they only have 10% of their taxable income that can be invested into the company to then purchase additional properties. And even furthermore here, you have to be careful about which REITs you're purchasing. And this is because some have extremely high management fees and transaction fees, which is just going to eat into your actual rate of return. And then once you get the dividends with a REIT, unlike other investments, it's not long-term capital gains here. It's actually taxed at your regular income. And so this just, again, eats into a little bit of that rate of return that you're getting. But the real question here is, how do you actually go about buying a REIT? Well, you can buy it just like you would any other stock on the open market. So you could talk with your broker and you could actually purchase a REIT. There's mutual funds, there's ETFs that you could purchase that are specific to REITs. And there's actually over 225 REITs that are out there for you to purchase. And this is just in the US market. There are options to buy international REITs. Now these generally do come with a bit higher rate of return, but they are a little more risky. But I think it's something that you could consider for your overall portfolio, because again, this is going to help you diversify if you have some US and overseas REITs. And actually the largest overseas REIT is what's called the non-US REIT, and it is a Vanguard Global ex-US Real Estate Index Fund, ETF, and its stock ticker is VNQI. And then there's also some other funds that you might want to check out, which is the iShares Dow Jones US Real Estate. There's the Vanguard REIT Index ETF. There's the SPDR Dow Jones REIT. There's the iShares Cohen and Steers Realty. And then some of the largest individual REITs to invest in are the Simons Property Group, Public Storage, Equity Residential, HCP, and Ventas. So my personal recommendation if you're looking to get involved in REIT investing is to look at the Vanguard ETF, which is VNQ. I think it's highly diversified, it's broad, and it also has low expense ratios at 0.12%. But with any investment that you're going to do, don't just do it because I or someone else on the internet is telling you to do it. You have to really understand the investment and make sure that you're confident and know what you're putting your money into. So as always, if you're getting value from this channel, please subscribe, hit that notification bell so you don't miss an upload, and make sure you hit that like button for this video as well. And so until next time, remember to think, dream, and believe in yourself. You got this.